Please welcome your panelists for Institutional Investors Thriving Amid Change, moderated by CEO of Victorian Funds Management Corporation, Lisa Gray.
Good afternoon, everyone. Really appreciate you coming along because we understand we're competing with a footballer and a world-class model. So we're very grateful for your time this afternoon. And we promise you an exciting panel. It's a really important topic. We have world-class institutional investors, sovereign wealth funds here with us this afternoon, and speaking about some really interesting things and how we thrive and survive amidst change that is amongst us. And it seems to me an incredibly timely topic because wherever you look, there is constant change or things are moving in different directions. I arrived from Australia on Saturday night, and there were two things dominating the TV here. One was Trump for a Nobel Peace Prize. And those of you who heard Tony Blair earlier on at lunchtime today, his statement on that around Trump for a Peace Prize was that, you know, an unpredictable personality trait can sometimes turn into a strategy. So we'll see how that one goes. The other thing that was dominating the news Saturday evening was, of course, Michelle Wolf at the White House Correspondents' Dinner as well, and the extreme views about what she spoke about as well. But we're not heading into any of those directions. We have four leading sovereign wealth funds, institutional investors here with us today, and they're very different organisations, but there are several things that are really common to all of them. One is that they are very much long-term, we are very much long-term investors, patient capital as such. All of these organisations, though, have an enduring purpose, and their purposes are around sustainability, around improving things for future generations. They're about improving prosperity and well-being as well for the countries and the funds that they're involved with. And sustainability and longevity is key to that. So let me introduce the panel members that we have this afternoon. To my right is Russell Reid, who is the CIO of the Alaskan Permanent Fund Corporation. Welcome, Russell. To Russell's right is Raphael Arndt, also known as Raf. So if I call him Raf from time to time, that's who I'm talking about. And Raf is the CIO of the Future Fund, which is Australia's sovereign wealth fund. Welcome. To my left is Dilhan Pillay. Dilhan is the Deputy CEO of Temasek International. So welcome to you, Dilhan. And then Tokihiko Shimizu, who is the CEO of the Japan Post Investment Corporation. Welcome, Toki. So we're going to go into a variety of different places with our conversation this afternoon, but I'm going to start off very much with the present. And so you can't talk to an investor at the moment or an asset manager and not talk about where are we in the cycle. You know, and we all talk about we're sort of somewhere later in the cycle, asset values are high, liquidity is being withdrawn, and we've been benefiting from the leverage and the tailwinds that's been giving us. But Dilhan, I'm going to start with you and ask you, what do you see as the impact as that leverage is withdrawn, and what might be the impact on assets and asset growth?
So I think, first of all, let me explain to you a little bit about Temasek. We're not really a fund. We are our own permanent capital vehicle, and we actually own a bunch of assets. 45% of our portfolio is in companies that we control, and the rest are in investments in companies either concentrated or not. For the last 15 years, we've been moving away from being Singapore-centric to being globally oriented, and today about 75% of our portfolio is outside of Singapore. As we look at investment patterns over the last few years, obviously in the last, I would say 5 or 6 years, the amount of liquidity that's come into the private markets, private equity, as well as the public markets, has really resulted in this huge asset inflation that we have never seen before. And you've seen earnings multiples at levels which are 1 to 2 standard deviation points above the norm. And you think about that, and you think about leverage and availability of leverage and the cost of leverage, there's no reason why you would not have to overpay for an asset today. And the reality of the situation also is that the market isn't actually pricing what we may be seeing ahead of ourselves. And there is a lot of desire to get yielding assets out there, and equities are sometimes a proxy for non-yielding assets that would otherwise traditionally be in the scope of what an asset manager might be looking at. So even though leverage is being taken away, in the private markets, you still see a lot of liquidity out there looking for investments to make. And quite apart from private equity funds or growth equity funds, you've seen the proliferation of family offices now bidding for assets. You've also now seen the proliferation of permanent capital vehicles for more longer dated investing in promising companies that have a particular, I would say, gradual growth profile. And that makes it still competitive for us to look for investments even in this market. And quite apart from how the public markets are performing, private markets are still remain expensive because of that. And the competition for good quality assets has just intensified. And so as much as we think that things may be tapering off in the next 12 months, for us, at least where we stand, the competition for good quality assets is still very, very high, very, very significant. So it doesn't look as though that situation is going to abate much, at least the next 6 to 12 months.
And uncorrelated returns, where are you looking for those?
So we don't do that because we're an absolute return entity, So we don't look at asset allocation for that purpose. But what we've done recently is to figure out whether we should take a view on some indexes with respect to certain geographies where we feel that there is a difficult environment for us to invest in. But otherwise, for us, it's a bottoms-up type focus on companies and good quality companies.
Great, thank you. Raph, how are you looking at the world at the moment?
Yeah, well, it's a pretty interesting time, that's for sure. And to your earlier question, when we look at it, the future fund's relatively young. It's 10 years old, and it's about in US dollars, roughly say $120 billion that we've got under management. And it's a long-term focus. And what does that mean? Well, last night I was talking to someone at dinner who was in equities and said, we're very lucky because we can take a long-term view. We're looking at 3 years, they said to me. And, I think that's probably our short-term view. We certainly wouldn't profess to have a view any shorter than that. But if we look at the impact of quantitative easing, and to be sure, central banks around the world have done a great job of averting a depression, which would have been far worse than what we have experienced, but there are consequences. The business cycle question, while relevant in the short term, is really insignificant compared to the, I guess, quantitative tightening that's going to have to take place. And we've had the Fed sort of start to slowly normalise interest rates. They're not particularly close to being normal, but we've still got that huge amount of liquidity in the system that will have to come out one way or another, either through economic growth over time, which will take a very long time, or actually shrinking the Fed's balance sheet. And so that's a pretty bad outlook for asset prices. Just as we've all benefited as investors from the last 10 years, we're going to have to face the headwinds of that change in policy. Economic growth helps for sure, and having skilled strategies and all those types of things, but at the end of the day, you're paddling against a very big current. So in terms of the future fund's view then, I think in the short term things could be quite good for a little while yet, but in the longer term we're much more pessimistic, and there's a whole lot of other trends. One of the slides that was put up at lunch by Mike Milken around population growth and in fact future population decline in the world, for example. The rise of populist politics and trade barriers and the impact that has on future economic growth. And to the earlier point about what a market's discounting, the answer is not a lot of bad news in most parts of the world. So our focus is very much on finding things that are not dependent on economic growth or continued leverage to be successful investments. And that's very difficult because that means that equities, for example, by and large are I mean, they're the biggest risk in our portfolio, as they would be for most people, but it's a risk we're very keen to diversify away from. But today bonds don't look all that attractive either. And so our main focus has been on things like building out the hedge fund strategy so it can be defensive in adverse market scenarios, but also looking for things that can benefit in a world without economic growth, such as early stage venture capital, because good ideas don't need economic growth. They need just an opportunity to be funded and take market share off someone else, but that creates problems for the rest of your portfolio.
You raised a couple of really interesting things. One about the whole assumption around economic growth as the model, which will come back, and I think it will pepper that through, and also about populist politics and impact on trade, which we'll touch on again shortly as well. Alaskan Permanent Fund, Russell, how's that approaching the environment as we see it today?
So the Permanent Fund is a $65 billion sovereign wealth fund, medium size by global terms. The thing that we're most known for, I think, is embodied by the Simpsons movie. So the Simpsons take a trip to Alaska, and upon hitting the border, someone in a hunting attire says, "Welcome to Alaska. Here's your $1,000." And and Homer responds, "About time." And that's pretty much what people think about with respect to the Permanent Fund. Namely, we provide a payment since 1982 to every man, woman, and child who lives in the state. And so that's been our only obligation since 1982. That's about to change. So we'll be shifting from being a sovereign wealth fund with a periodic annual dividend payment to the Simpsons and others to something new, a sovereign endowment fund, like a big university. So think of us as like Harvard, twice as big and not quite as well educated all the time. So for us, the key to investments is, I think, parallel to our peers, but we have some other challenges and we have some other advantages. But the size of my investment team is 25 people, 45 people total. This is actually fairly small in terms of number of people for the assets that we manage. So the importance of partnerships is critical, especially as we look to the high growth regions of the world. We take the high population growth and economic growth regions of the world pretty seriously, from Africa through the Middle East through South Asia. We enter into partnerships on a few different levels. Those partnerships are with peer plans. Those partnerships are also with fund managers. So we don't necessarily, sometimes we rather than disintermediating a fund manager, we might actually work with them to develop a product or an initiative where they can act to multiply our scale. So if our peers might have several times the number of personnel, how are we going to compete or be good peers with them? We're going to do it in partnership with others.
Great, thank you. And Toki, just to wrap out this part of it, I mean, Japan's been living with low interest rates, low growth, low inflation for a considerable period of time. I mean, what lessons do you have for the rest of us about that kind of environment?
Yes, thank you. Before that, Japan Post Bank, let me introduce the brief outline of Japan Post Bank. Japan Post Bank have a very, very long history, about 150 years. But we have been a part of a government body. But 10 years ago, 2007, we privatized. And 2 years ago, went public. And we manage about $2 trillion. And from the 2 years ago, we accelerate our investment strategy to the aggressive one. And as for the alternative investing, we try to allocate $60 billion to the alternative space, which including private equity and infrastructure and real estate. And we are a Japanese bank, and our liability is Japanese yen. So we try to invest, or we are trying to find a very good investment opportunity in domestic. From the viewpoint, obviously, Japanese BOJ keeps minus, negative, interest rate policy, and that and the zero interest policy is a very long time we have, and the asset pricing is very high. But in terms of the efficiency of the company, Japanese companies' ROE is half of the US. And actually, private equity deals in Japan at this moment is, I think, 10 price multiple. 10x is the same standard of US. But if we think about our EBITDA is very, very low, because of inefficiency of the Japanese company's management. So if the Japanese management company's efficiency is going up, and the price is, I think it's not high at this moment.
Great, thank you. So that gives you a bit of a sense of how our panellists are thinking about today, but also a sense of where they're thinking into the future as well. I just want to change tack now and look at, there's a whole variety of things impacting our investing environment. Consumer preferences, technology, digital disruption, and a whole range of ways we as organisations need to cope with that as well, not to mention populist politics, etc. as well. So Russell, I might start with you. If we look at consumer preferences, I mean, how do you use consumer preferences and how they're changing, or even generational change, when you look at new investment ideas?
So the consumer has always been an important theme, and we've thought of it largely in the context of the U.S. consumer in particular, because we have been big consumers and because many U.S. public programs were largely U.S.-oriented. That's been changing, and one of our most important themes that we're looking at is the rise of a consumer class, for instance, in half the world. So when we take a look at that region from South Asia through Africa, for instance, the things that come through are things like the 300 million consumer class citizens that have emerged across Africa, consuming $1 trillion of goods. So they're not a traditional middle class, but they are consumer class. And so I'd say the rise of the consumer is one which has been important on a global basis, and it's meant something different in the U.S. than it does in China, than it does in the Middle East. So I'd say that one of our biggest themes is following the consumer.
Yeah. Okay, great. Raph, I know you think about consumers also and about the multi-generations as well. So how are you looking at consumer trends and generational trends? Yeah,
well, in the developed world, I'd probably think about it more broadly than just in terms of consumption. So we've got along with the change in the leverage, the population growth, the populist politics, we've got two other really big changes going on right now. One is a generational change where the millennials and Gen Z together within 10 years are going to be more than half the population, and already increasingly a dominant part of the workforce. The millennials are. Gen Z hasn't really turned up yet, they're only just starting, while the boomers have shrunk to almost insignificant proportions in terms of the workplace and spending power. And here in the US, my understanding is that millennials today as a group have higher disposable income than boomers, for example. And we've looked at this through the lens of our real estate platform. So as while, for example, dominant shopping malls have been sold off recently, actually there are some opportunities arising for those that can reposition themselves for the new generations who act completely differently, they spend differently, they consume differently, they're motivated by different things. And just to use that example, here in the US, the millennial has a higher propensity to go to a shopping mall than the boomer, but they go for an experience, they go for a meal, they go to the gym, they go to interact with people, they don't go necessarily to buy something. And so you're seeing the department stores close and get replaced by golf driving ranges and food streets and other experiential type things.
Right.
Just to put a slightly different lens of it, China's a whole other story, and that's a really interesting place to go. And if you haven't gone recently, I'd really strongly encourage that you do that, because the same generational change is happening in China, but the whole way they consume is quite different, and it's quite technology enabled. And if you're not on WeChat, you should have a look at it to understand it, because that's how a whole generation of Chinese people are interacting with each other, and that's creating tremendous opportunity. And we've got quite a reasonable sized program of direct onshore investment in China in private equity and venture capital to take advantage of that.
Right. I want to come to technology and disruption next, actually. But Dilhan, consumer preferences, how are they impacting your ideas?
So from about 13 years ago, when we looked at changing our model to more growth equity investing, we had 4 themes to go by. The first was urbanization. The second was growing middle-income populations. The third was about investing in companies with comparative advantages, and the fourth were emerging champions. And we decided that in the context of what we were seeing, we should focus on emerging Asia. So we went into India and China back in 2004. Today, China accounts for 25% of our portfolio exposure. That's about 60 billion US. And India is roughly about 5%, and the US is about 12. Now, if we look at that, emerging market consumption is clearly something that we are very focused on. By the way, aging also is something we're focused on. I'll tell you why in a little while. So emerging market consumption has been a theme that we've played since 2004. It's played itself quite well, especially since China has gravitated more towards a consumption-based economy. And you look, and that's one country where you see the real convergence of technology and consumer preferences. Really, you know, as Rafe was saying, WeChat is today the ubiquitous way in which people communicate, exchange views about what they see, what they've experienced, and really, you know, you can get yourself in a very positive position or a very negative position via WeChat. The other thing about China is that there is this real desire on part of most corporations to make use of data, you know, very, very significantly in the business that you do. And you see that in the consumer sector. So what we've done since 2011 was to focus on financial services, technology, and consumer. And really, in emerging market, that's where we've seen the best returns from investing, especially when you invest earlier. We have a venture capital arm that invests in Series A, then we ourselves invest in B, and we have separate pockets of capital for C and D and E. And each one of them we look at from a different lens. And today, we're beginning to realize that you can capture trends pretty early, and then you try to invest further up the stream as you see more and more convergence of this issue of data and consumer preferences coming through that. And so that's what we've done, and so far that's worked out reasonably well for us.
A few of you have touched on technology, and you can't talk about technology without then linking the word disruption, and that has impacts as investors, also has impacts on how we run our own organisations as well. But let's stay at the external lens first of all. I mean, there's a lot of talk around what is disruption actually, and which industries does it disrupt? I mean, Russell, what are your thoughts around disruption and technology?
So I'd say as a precept, we enter into private equity, in particular venture capital, only if we think it's going to be disruptive.
Yeah.
You know, it's very difficult for us not to make something that we think is where transformation is not part and parcel of the investment. Interestingly enough, we've had special success in areas that we wouldn't have necessarily thought going back 10 or 20 years ago. Our most successful area of venture capital, for instance, is in biotechnology. So there are a curious number of biotechnology companies that have Alaska-sounding names. But I would say that this has actually made us among the most successful venture capital investors across the U.S. So our viewpoint is that it's you shouldn't generally just allocate to venture capital. It's all a matter of gaining expertise. in particular areas. If you don't have an expertise, just allocating to the sector doesn't do much for you. It's very different than in stocks and bonds. With stocks and bonds, allocation matters the most. In the private markets, including venture capital, the execution matters the most. The difference between an excellent venture capital program and a poor venture capital program can be 2,000 basis points annually. And this has been not lost on us. So developing particular areas of expertise and not necessarily investing across the board in venture capital.
Yeah. And when you look at different opportunities, particularly with regard to disruption, technology, etc., are there industries or sectors you stay away from?
In many ways, what we heard earlier from Dilhan, from Dilhan is how we view the world, namely thematically. What are the themes that we think are going to represent long-term value-added possibilities for us? So things like, we'd agree with several of them. Urbanization is one that we look at seriously. Another one is smart cities development. Doesn't take many trips to places like Nairobi or Beijing to start wondering exactly how is this going to work in the future. And so we think smart cities development is one of the thematic areas across asset classes that we think will have legs for some time, that we would like to develop expertise in.
And Raph, I know the Future Fund thinks a lot about technology, but particularly how it's impacting you as an organisation and even the cultural elements of that. Yeah,
so I think when you talk about disruption, technological disruption, we're living through one of those, I think, one of those productivity booms that happens every 100 years or so, and everything is changing, absolutely everything. So if you're looking at a sector that you don't think has been impacted, it's just because it hasn't been impacted yet, not because it won't be. And it's sort of curious to us that as we look at ourselves, and I think all of us up here on this stage have the benefit of only having one stakeholder, and to some extent you could say we're not exposed to competition in the way that a private business in funds management would be. It doesn't mean that we're not ourselves prone to disruption, because as technology changes, as more big data techniques are brought into asset management, which they will be, then we will fall behind, and our stakeholders ultimately, slow moving as they might be, will ultimately say maybe we need to change how we invest this pool of capital. But also because we've got quite a large venture capital program and quite a large hedge fund program, and a lot of the hedge fund managers also use technology and big data, we can see what's going on. And so we've actually start to apply that to ourselves and say, how can we get better? And how can we better understand our portfolio, what's in it in real time, looking through all the private market funds, looking at the underlying currencies, looking at the sector dispersion, all those types of things, looking at what works, what doesn't, how much factor exposure do we have, is it what we thought we had? And we've been investing into our own systems. We've been hiring people who can code to come in-house to help us put things together, and we're just in the process of beefing up our capacity in that area. On the disruption side, I've actually created a role for someone whose job it is to worry about the impact of technological disruption on the rest of our portfolio. You can't tell who's going to win and lose. I think that's a mug's game. We don't know. But we can make sure that whatever we do know, we're imparting to the people making the investment decision, so they can make sure they're taking it into account, and they can think to themselves, am I getting compensated for that risk?
Yeah, thank you. And Toki, how's Japan Post using technology, both internally or as you think about new investment opportunities?
Yes, before that, Japan Post Investment Corporations is the subsidiary of the Japan Post Bank and Japan Post Insurance companies, and they are dedicated to their direct investment in the private equity market. And our firm is very unique here because in general, the private equity fund and venture capital fund is separate. But in our case, we focus on the three strategy in one bucket. That means the private equity deal and growth equity deal and technology. And why? it's very, I think it's related to your questions. I think there are a lot of emerging disruptive technology came from the venture capital. And that kind of techniques, disruptive techniques, impact, take very, very great impact, big impact on conventional blue chip companies. So our strategy is these three buckets is not think separately, but we think about that, our leverage. And that's why our strategy is unique. Yeah. But at the same time, I think there are three areas going forward. Disrupted company like Facebook or something, and one is obviously Facebook. One is obviously deep learning techniques, and another is blockchain techniques, and third is high performing computer space. And I think these three strategies, these three techniques make the world more better. And we focus on that.
Well, I think one of the themes around the whole conference is a lot of conversation around artificial intelligence as well, and that will impact all of our industries, including asset management as well. Just before, I'm going to move shortly to talking about ageing population and populist politics, but just wondering how any of you see, with the advent of technology in your own organisations, is that changing your role as CEO, CIO? How's that impacting you?
Yeah, I might have a go.
Yeah.
So the first thing I would say, just again for some context, I've got about 70 people in the investment team, and we only implement through fund managers, and we've got about 120 fund manager relationships. I don't really do investment. That's not the job of a CIO anymore, I don't think. I really set a culture and a strategy and to some extent a process to make sure that the right people with the right information are coming together to share ideas in order to all move forward in one direction rather than in competing directions. And I think, the modern workplace, whether it's in our industry or any industry, looks very much like that these days. And the people coming into it who have fresh ideas that we need given all the changes going on in the world, they demand that type of workplace. They're not going to put up with the hierarchical, top-down directive type of environment. The world we're in, as I've been saying, is different. So someone who's got 20 or 30 or 40 years of experience through the regimes that we know might be more a liability than a benefit going forward, I think. Because the assumption that markets will keep working the same isn't necessarily true. So I spent a lot of time thinking about culture, about the environment, and in particular about how to elevate the voices that are different so that we can have a constructive dialogue. Yeah. And technology actually plays a part in that too, in sharing information, in letting people around a committee table vote in a silent way so that if you're not the loudest voice in the room or if you're the outlier, you can feel safe to air your view, and then we can say, oh, it's interesting because 6 of us voted that way and 1 of us voted that way. Let's hear from you. Why did you have a different view? Let's learn something from that. That's probably the most valuable view in the room.
Thank you. Russell?
I'd say with technology, the biggest opportunity that we're seeing is the ability to apply it for accessing markets that we haven't in the past. And some of these changes are fairly dramatic. The U.S. fixed income story had been one. Well, fixed income in general we thought of it as mostly a U.S. story, and that's been changing fairly dramatically. We, on the stage, have a special status in general of being able to have currency convertibility like our monetary authorities, our country's monetary authorities, so different than pension systems, and we tend to be able to invest in a much wider class of fixed income assets than many of our peers, foundation or pension peers. So how do we trade, for for instance, local Indian debt. That's both it's an investment story and it's a technology story. And we're seeing that the differences aren't a few basis points. The differences can be percentage points. And so I'd say that getting the technology story right means that we can access quality and quantity of opportunity that other people can't. So we view it in pretty serious terms.
Thank you. We've talked a bit about generational change, not only culturally, but from an investment perspective. Toki, I'm thinking all of us operate largely in ageing populations where we operate from where we're domiciled. But Japan clearly also has an ageing population. How's that impacting how you may invest, your fund itself, or even the healthcare system in Japan?
Yes, obviously, by population aging, Japan is number one. And actually, public pension schemes and also insurance scheme is affected hugely by the population aging. And I think in this area, our life is almost of the 100 years, but at the same time, our retirement age is 60. We have to live the 40 years in retirement. It doesn't make sense. It doesn't make sense. So the things we have to do is to overcome that kind of things. It's two options. One is recurrent educations, and another is working more longer. It's all. But at the same time, AI things like deep learning or such kind of things, mitigate the population reductions in a little bit.
Or we might do a poll. Who wants to work longer? Anyone up for that? If we talk about one of the other trends, Dilhan, that we're seeing, and we've touched on a little bit, is rising nationalism, populist politics, potential trade conflicts, etc. I mean, how are you seing that? A lot of it's about distribution of wealth as well historically. So how is that impacting how you invest?
So I think if you look at it, the assumption that you have to make is that it's going to increase, especially when you think about Industry 4.0 and its impact, right? Because as you think about it, the pace of disruption is likely to quicken. And the ability to reconstruct their economies and create good jobs for those who might become displaced as a result of it is a very, very difficult thing to do. Typically in previous industrial revolutions, you've had a much longer time to actually discuss strategies or think through strategies to negate the impact of that. Today it's a little bit more difficult. The other thing about it, of course, is that people are going to live much longer. So you've got to figure out how there is a proper distribution of the benefits of disruption to society. I think that needs quite a bit of debate because that's being felt on the ground. Yep. So we can think intellectually about the benefits of technological improvements and so on, and that's fine because there is a benefit that comes from that. But we also have to think about the sociological impact of it and the impact on populations who bear the consequences of disruption. So I think that is something that we have to think about. Now, aging is an issue too. You know, so in the context of aging, you have the need to make sure that you have enough savings. And you know, in Asia in particular, pension systems are not so well developed in most countries, and yet those countries are now seeing longer life expectancy numbers. And so when people are going to live to the 80s, you know, there is that pressure that's going to be put on to governments to ensure that you know, that they can provide for social programs to cope with aging populations. Then on the positive side of it, if you're investing in companies which are focused on consumer patterns linked to aging populations, then the connected world and the connected home and so on. There are opportunities there as well. It also does make aging a lot easier for people. It does allow for it does allow you to manage, for example, healthcare costs. If you look at personalized medicine and things like that, and I think there are opportunities in that sector as well for you as an investor. But it's a big issue in Asia because if you look at the aging trend in Asia, you're going to see a shift towards people aging more quickly than seeing the total fertility rate go up to cope with that aging. And China is the biggest one, right? Because China currently has about 200 million people aged 60 and above, and that's going to rise to 500 million in 25, 30 years. And so, in Asia, you're seeing that whole shift, and you're going to have to think about what that means in the context of people living good lives, and for society to maintain its equilibrium. Now, nationalism, that is a big issue, right? Because for us, we would like to be welcome in countries to invest responsibly and to add to growth. Nationalism could have the unintended consequences of preventing sovereign wealth funds from being able to deploy capital where it could be useful to economies. So we have to see where that goes.
Thank you. Now, we are shortly going to open it up for questions, but I have one sort of big question I want to ask each of the panellists before we do that. And it's to get the crystal ball out, which we love to do in our industry. So, in a world of transition, where are each of you looking for the really innovative ideas about where the big investment opportunities are for the next 50 years, 50 years? Would you like to go first?
So for us, the demographic story is the 50-year story. And when we look at that region from South Asia through Africa, representing 44% of the world's population today, it also represents 12% of its GDP, 6% of its market capitalization, and only 2% of major international global indices. So that number is going to be changing significantly. By the year 2050, instead of 44% of the population, it'll be 56% of the world's population. Likely, we think, looking at prevailing GDP growth rates in that region compared to the OECD, it's running about 2 to 3 times. So we expect the portion of GDP is not going to be 12%. It's going to be much higher, probably outpacing the growth in population. Faster still will be the market capitalization. That will not be a 6% number. Half the world's population, 56% of the world's population, is not going to be represented by 6% of the market cap, and definitely not 2% of major global indices. So we think that that's a pervasive opportunity, not only in equities, but across the private markets as well.
Okay, thank you. Raph.
So they told me to be controversial when you came and sat on the panel. So I agree with you, Russell, about the thematic. I think the problem, though, is that the nationalist politics that is here to stay, I think, for some time, means that we can't take for granted the openness of capital markets. And so we have to think through that lens as well, certainly over decade-type time horizons, and the world's been there before. And so I think one asset class that's really undervalued right now is flexibility, cash, because the option value of cash, although it doesn't return very much, we're in a time of increased volatility, we're in a regime shift, we've got all these trends in the world, and if you're prepared to, let's call it underperform, if you've got a long time horizon and an absolute return, there's no such thing, but for a period, and then be brave enough to deploy that if and when things correct, then that's something that we need to take into account as well.
So you're still holding very much to the economic model may not be one of high growth. Yeah.
I think, well, the first thing is to say we don't know, right? And if we do think we know, we're kidding ourselves, all of us. But we know that the future is much less certain, and so we know that the value of flexibility in the portfolio is higher than it has been in the past. And so, for example, at the Future Fund, we've been shrinking the private asset portfolio. Most other people are going the other way. And there are certainly parts of that universe where we think the illiquidity premium, so-called, is negative right now, especially for the longer duration, lower risk assets, because I think discounting back multiple decades of economic growth and prevailing leverage at a low discount rate is very, very risky right now. And we've been rotating that portfolio into much more shorter term strategies, value added activities, things which are true turnaround or create an asset and then sell it. I call it creating core, create something that someone else wants to buy and sell it to them. But by and large, just the value of staying flexible is very important.
So Toki, you're hearing Raph saying he's reducing his private, some parts of his private portfolio, and that's an area obviously that you have been starting to invest in over the last few years. How are you seeing the next 50 years?
Yes, yeah, our future is a thing that yeah, to be forecast, predict. Yeah, but I think future is to be create by ourselves. And from that point, I think most important things is to find the social issues. And our investment policy is to resolve social issues by long-term investing. Yeah. And in that context, we have a lot of social issues which we share. For example, global warming, and also space debris, and high performance computing, and there are a lot of issues. And also ownership of the big data. Yeah, actually, recently the Facebook is they have an issue of the data leakage, and the AI thinks the problem is a company, IT company, gathering all of the big data, and ownership of the big data is, I think, will be the big issue for human people, and we have to find that kind of issues and resolve.
So how are you looking to use big data for the next 50 years?
I don't know. Sorry. Yeah. I don't know, but yeah, in Japan, obviously, a population problem.
Yeah, great. And Dilhan, what's on the horizon for you over the next 50 years?
I think if I was to look back to 1968 and think, will we be where we are today in 2018 with what we're seeing, I don't think we could have predicted exactly what we're seeing today. So I'm not sure I can predict what we're going to be seeing in 50 years' time. We have certain trends that we are focused on. The first is, of course, the whole issue of automation, data, artificial intelligence. And that runs across multiple sectors. So we think of that as a horizontal, and trying to figure out what the impact will be on different sectors, and in fact the companies that we own in those sectors and that we control, and how can we anticipate the changes in those industries and sectors ahead of time. Second is aging, because we see that particularly in our own region. And we see different consumption patterns arising from that, and other issues like I mentioned, healthcare and so on. The third would be the connected world, and what are the opportunities that come from that, because that's a reality that we are looking at. The fourth, which is the other reality, is eco-consciousness. And I think that's very important. I think it's becoming more and more important to the younger generation, to the millennial generation. And if we as institutions don't look at that seriously, then I don't know whether we're going to be an attractive place for the millennials as well. The fifth is actually EM consumption, which is a continuing thing from what we saw from 13 years ago. But it will, for the reasons that Russell brought up and so on, we will see, more and more consumers coming to the market, and they will have different desires, different interests that we want to try to see if we can predict. But a lot of it may be more localized, by the way. Something that's sold in China not necessarily be applicable elsewhere. So you might find that opportunities you see might be more domestically oriented than one which has a global application. But yet, it's something to watch out for. And finally, it's the sharing economy, because I think that's going to grow. So these are sort of the six big things that we're thinking about. I'm not sure that they're going to be relevant for 50 years, but we do think for 10 or 15 years that they will be relevant to us.
Thank you, absolutely. Let's pause there for a moment and see if there are any questions for the panel. I'm not sure if we've got mics. We do, great.
You all mentioned that venture capital is an interesting area for you to potentially expand further. As a venture capitalist, I'm really happy to hear you say that. But I guess we've seen pretty dramatic expansion in a lot of areas. Growth in corporate venture capital, growth in late-stage venture capital, particularly out of China, Japan, Middle East. Just in general, a lot of optimism. Historically, the asset class has been tiny compared to any other asset class. Do you think continued growth in venture capital is sustainable and scalable, and will there be compression in returns, or do you think that there's systemic changes that are allowing more capital to be deployed in private companies?
I'd like to jump in on that. So I'm pretty bullish on venture capital as an industry and as a sector. And one of the big changes I think that we've seen is that the U.S. was historically was both a center of innovation, center of venture capital, and a center of the projects which deployed the venture capital. And I think some of that is changing pretty dramatically depending on what sector of venture capital. One of the biggest changes, for instance, is in alternative energy, where you can have great innovation from a place like the United States, but the best places to deploy the innovation may not be the U.S. or the developed markets at all. It can be the emerging markets. So I think that shift where innovation happens in one place but is deployed in another at scale is a pretty big fundamental change, and it's one which we think is actually positive for the industry. You know, that you don't have to invent and be a venture capitalist in one area and just deploy the projects there. It can be in other places. So I think we're trying to learn what that new ecosystem really looks like.
Right. Anyone else want to pile on that?
Yeah, I think so. So we've got probably about $3 billion in early stage venture capital, and I think clearly, as you allude, there's certain big checks in the market sort of impacting particularly the late stage market, and that I think is something we're trying to shy away from or sell to. But on the early stage side, we're not really seeing any slowdown in idea generation, and so we're still maintaining the exposure. We're not aggressively growing it, but there seems to be enough innovative ideas to maintain what we've got.
Right, thanks. Now we had a question down the back there, thanks. And then yourself, that's it.
Thank you. Colin Tate's my name from Connexus Financial and top1000funds.com. My question for the asset owners is do you feel that your fiduciary duty and obligations is changing in any way, the definition of that, and in particular whether your power, money or influence is more now required on matters such as social change, things like the widening health gap and other things that arguably bring political and economic insecurity?
Well, we're in a different position, I think, from an asset allocator because, as I said, we're not a fund. We're a permanent capital vehicle. Having said that, we have one shareholder, and we have a responsibility to give long-term sustainable returns to that shareholder. And that's the term that they use, long-term sustainable returns. So we do have a model that tries to project the construction of our portfolio as against that long-term sustainable return in order for our shareholder to have some level of predictability in what they can expect from us every year when we give a dividend to them. And in the context of an aging population in a country like mine, where the median age is now at 40 and the dependency ratio is changing, the need to fund social programs comes from the returns of our sovereign wealth fund, which is GIC, and ourselves. So that is a responsibility that we put on ourselves, but it's it's not mandated by the government, but it's something that we know we have to deliver in order to continue to be relevant to them, so that they don't shut us down. So that's something that we do. We're not involved in the political or social policies of our government. That's for them to determine. So we look at it purely from a commercial perspective.
Thanks, Dilhan. Russell?
We have a view on impact investing that is different by asset class. Historically, a lot of the focus on impact investing, we think at its worst, was on divestment campaigns in public equities. And our view is that generally the result of divestment programs was limiting the opportunity set of our investments, concentrating our risks, and this is generally doesn't lead to a very happy result for either our internal managers or external managers. Now, as we move up toward activism, activism better than divestment, better still, and what we actually can get, what we can rally around are transformative investments in the private markets, where we can help create companies that wouldn't exist otherwise, whether it's ones that deal with new cancer treatments or new technologies with IT or with energy. So when we think about, for instance, smart cities as a theme, we're not thinking about sacrificing returns at all. We actually we think of focusing our capabilities so we can enable new companies to arise. So the more we can think at a higher level, constructive level, on transformative investments, the better.
Right, thank you. And we've got time for one last question at the front here.
Thank you very much. As Prime Minister Blair...
Sorry, that's not working. Try again.
As Prime Minister Blair mentioned in the lunch meeting, the discipline of China is totally different. Their lack of freedom or democracy or rule of law. So, from the viewpoint of the 50 years investment perspective, how do you evaluate the Chinese economy?
Okay. Do you want to go?
Sure. Well, look, I think there's a difference between the economy and the politics, and I think you're referring to I guess what we might call sovereign risk in terms of what does it mean for an investor to invest into that economy. I won't go over all the tailwinds and things, we've covered that. I think the Chinese government is very well aware of its need to attract foreign capital, even though there's plenty of savings in China itself. And in the last few years, we've seen a lot of positive moves in terms of the fixing of the currency, for example, to a basket, direct convertibility, slowly increasing the access for foreigners into the equity markets, the bond markets coming and so on. So the signs are positive. And yes, there are concerns, but I would say equally there are concerns as a foreigner here in the US with the president that's talking about trade barriers and harder foreign investment rules. And while they're not starting from the same place, I think the trend here in the US looks in some ways worse than the trend in China.
Thanks, Rob. Thank you. So I think this afternoon you've had a sense of a variety of different views, a sense of where there might be some potential risks and landmines, but overall a sense of optimism actually, where there are a variety of different opportunities that the panellists have seen. And I hope you've also got a sense of the signposts and the triggers that these global investors are looking at and where they see many of the opportunities as well. So please join me in thanking our panel. Thank you.